where we are going to be focusing on rule and threshold selection in order to create a hyper-efficient compliance program.
We're not the FBI, but we have that hunch because of our expertise, right?
Compliance programs are ever evolving. It's like maintaining a garden. It's not like building a sculpture.
All the topics which we are going to be discussing are very close to my heart.
Think about your AML OFAC risk assessment as the foundation of your compliance framework.
Everything is audit backwards. And just ongoing engagement, right?
Hello, everyone. Thanks for joining us today in a first webinar hosted by Flagright, where we are going to be focusing on rule and threshold selection in order to create a hyper-efficient compliance program. So we're going to delve deep into the practical steps on how to approach rule setting during the launch, how to adjust the rules post-deployment, discuss some practical steps on how to cut noise, aka false positives, sharpen the detection, and how to prove everything, the whole email control effectiveness for all the relevant stakeholders, such as regulators or just the board of the financial institution. So to give a little bit of intro about myself, so my name is Pavlos. I'm a customer success manager here at Flagright, and since my job is directly related to optimizing and configuring system features for our customers, and one of those system features being transaction monitoring rules, the topic is super relevant for me as well. I also come from a email compliance background, having spent nearly 8 years in the area. So all the topics which we are going to be discussing are very close to my heart, and I cannot wait for our speakers to share some of valuable insights. And speaking about the speakers, today I have two professionals of their respective areas whom I'd like to introduce right now. So first off, we have a founder and CEO of 5 Pillars of Compliance, Vick Ekizian. So Vick, I'll give the floor to you now to tell a couple of words about yourself and what you do on a daily basis.
Thank you, Pavlos. Good morning, good afternoon, wherever you are in the world. I'm based in Los Angeles, California, so it's early morning here. Again, I'm the founder and CEO of 5 Pillars Compliance. As you can tell, the company was founded, the name was founded under the principles of the BSA, so the Bank Secrecy Act, with regards to the 5 pillars of compliance. We specialize in facilitating market entry for startups or emerging fintechs in the payment space, crypto, and so forth. We helped put together AML policies, procedures, act within the capacity of a fractional AML officer for these startup founders, as well as vetting vendors, the right vendors for them for different areas within their compliance operations, such as KYC, transaction monitoring, and so forth. And lastly, we provide annual independent AML reviews for those that are primarily required to have independent reviews, whether it's from regulators or their banking partners. So we kind of help facilitate that, primarily targeted for early stage startups again and emerging startups. Just a quick background about me. I've been in the financial services industry, primarily in compliance and risk management, both on consumer compliance and AML compliance for nearly 2 decades. I'm just kind of going on 18 years now, from traditional banking to fintechs to consulting, as well as a short period of time being a federal examiner with the regulator here in the US, primarily doing targeted BSA examinations for credit unions. So thank you very much for having me today.
All right. Thanks. It's a pleasure. Okay, thanks. And on the other side of the ring, to cover the things from more of a technical point of view and to show some practical examples on how the tips and tricks which we discussed might look like in action, we have a co-founder and CTO of Flagright, Madhu Nadig. So Madhu, over to you, sir.
Thank you. Yeah, great to be here and excited for the session with Vick today. I'm the technical founder at Flagright. From my background, as you can probably see, I'm from SF, same time zone as Vick, so it is early in the morning here as well. And yeah, so Flagright is a AI native AML platform, takes care of transaction monitoring, case management, customer risk rating, as well as customer screening, right? Both transaction and customer screening. And yeah, really excited to get the conversation going today.
All right, cool to hear that you both are excited. So thank you both for the intros. And before kicking off with the questions, I want to mention for the audience that in the menu bar on the bottom of the screen, we have a Q&A box. So feel free to shoot any questions you have for our analysts. And if we have any time throughout the middle of the session or maybe at the end of the session, we're gonna make sure to tackle those questions. Alrighty, so let's start discussing transaction monitoring rules and rule thresholds then. And Vic, I have a first question for you. So before we even start how to tackle some typologies and what rules should be implemented at the start, we need some place to put all those rules somewhere, aka to have a transaction monitoring system. So what would you say is, in your opinion, would be a few of the most important things looking from the compliance standpoint when scoping for the potential vendor for this purpose?
Yeah, thank you, Pavlos. So before I answer that question, let me kind of preface this with some sort of an opening and a setting, how we're going to go about transaction monitoring and selecting the right vendor, right? So I would say we all need to understand that transaction monitoring is a cornerstone of the BSA, right? It's the fundamental idea of identifying, detecting, and preventing potential money laundering, sanctions, terrorist financing, any type of illicit activity. So before we get into that, this is where sort of the compliance mindset or the investigator's mindset come into place. It's not really reacting to regulations or the requirements of regulations to have a transaction monitoring system to be able to identify and to prevent and review alerts and so forth. It's literally about understanding what it is that you're looking for. It's really having that hunch that it's not about the alerts that you're reviewing, but that hunch that, something does not seem right. Something does sound or look unusual or suspicious. We're not here. We're not a investigator. We're not the FBI. We're not Secret Service or anybody like that. But we have that hunch because of our expertise, right? So it's really important to understand why it is what we're doing. It's not really just, again, the regulators are asking us to do. It's literally about having that mindset of protecting and defending your products, your services. But now think about, kind of having a gate there, a border there, whatever you want to call it, so that these criminals don't exploit your business. So having that approach in the get-go is really important. Of course, that has to be substituted with skill set that is able to kind of identify these sort of patterns of unusual behaviors. So to answer your question about selecting the right vendor, there's a couple of things here that whether the board needs to know, the leadership needs to know, and then also the compliance professionals. I don't, think that compliance professionals wouldn't know, but there are a couple of things that are very important in selecting the right vendor. In my opinion, I would say one is ongoing customer support. What that means is looking for a vendor that really understands financial crime. I'm not looking really for just coders or customer service representatives. I'm really looking for a partner here. I'm looking for someone that understands the financial crime environment, certain typologies, because whether it's me or the compliance team, we need to kind of engage as our business grows. So we really need someone, when I say someone, the vendors, that they're able to scale, they're flexible. So as my business grows as a fintech entrepreneur, as my products and services, improve and enhance, and I'm adding new features, I want to know that this partner is capable of scaling with me as well. Also, scalability with, new typologies out there. Are they kind of enhancing and improving their algorithms, their scenarios, and so forth? So that's another thing important for me. The third important is the UI. Yes, it sounds very cliche, but having a nice dashboard, a platform, and sort of a workflow is really important, because otherwise it's going to cause to an analyst fatigue, right? You want to be able to have a certain UI where there's efficient, whether it's graphs, efficient structure of the alerts, being able to assign and reassign and kind of review. So that's really important, because you definitely don't want to have an analyst fatigue and just going from one interface to another. It just needs to be a little bit more intuitive. Another thing that I could think of that's really important to me is having a case management system. This is where the rubber meets the road, right? So it's it's really important to be able to have the ability to, have documentation capabilities, like be able to document, be able to, again, assign from myself to an analyst to maybe a level 2 analyst. Again, as the compliance team grows, you are probably going to have certain level of compliance teams, analysts, to be able to pick up on, low level alerts versus escalated alerts that have become a case for investigation. And then furthermore, you want to be able to possibly assign it to a senior management for review and decision making of some sort. So that's really important. And then finally, audit trail. I mean, you want to know when a rule was changed, the threshold was changed, when, why, all of these audit trails you want to be able to capture and retrieve, especially during audits and examinations. So those are a couple of the things that, in my mind, are really important in setting and selecting a vendor. So again, we're not really looking for a product. We're really looking for a partnership to kind of grow together, and as scale, they're able to improve us as well.
All right, thanks. Thank you very much. I really related to the things you said, having been an analyst myself for a couple of years, especially to the user interface part, even though you said it's cliche, but I still sometimes get nightmares, of some systems I had to use before, where it would take you 10 to 15 minutes to close a simple screening or transaction monitoring alert, just because you have to choose a disposition and then a sub disposition from two different drop-down menus next to each hit, purely due to the user interface limitations. And when you have dozens of hits, the struggle can get really quick, I think. So yeah.
Yeah. And then again, to your point, you want to be able to,
Sorry.
kind of set some sort of, potentially a desktop procedure for your analyst, because the analysts, there's going to be one day analysts coming in, one day going out. So like you want to be able to have a good, effective sort of desktop procedures to be able to kind of, again, navigate through the UI. So to your point, yeah, definitely, that fatigue is a big concern there.
Exactly. Do anything you would like to add or share here?
Yeah, absolutely. I think, some of the points Vic made are super relevant, especially, concerning like audit trails and just the ongoing support. Compliance programs are ever evolving, right? It's like maintaining a garden. It's not like building a sculpture where you just, get a vendor, get a system in place, and it's done. It's like you gotta constantly maintain it. The regulations are changing, user behavior changes all the time. And as any organization, could be a fintech, but even large organizations, there's always business development movement, right? Maybe you're expanding to a new jurisdiction, or maybe you're pulling back from a jurisdiction, it's a new product, or you have a new kind of partnership on how transactions flow through different systems. So yeah, I think from what you've seen as a vendor, what has really helped Flagright is just the adaptability, having like a compliance mindset to systems where everything is audit backwards, and just ongoing engagement, right? So I think that's been pretty key to us in working with our customers as well.
Yeah, being a customer success manager here, I can confirm for that. Yeah. Alrighty. So the next step in the process would probably be to start setting up some rules once you choose a vendor. So getting back to you, what would you say, how should fintechs approach the rule setup, especially if they are building those rules from scratch totally?
Yeah, so absolutely. So I think here's where I would suggest they start. It all starts from your risk appetite, right? Think about your AML, OFAC risk assessment as the foundation of your compliance framework. It's that skeleton. Without it, you're lost. You just won't be able to function. Why this is important, why is it the foundation, is because here in your AML risk assessment, and we're just going to call it AML risk assessment, you're identifying inherent risks, right? You're identifying your high-risk products, like what your products are, what you're offering, who your customer base is. Are they consumers? Are they businesses? Are you offering services to, internationally, certain jurisdictions that might be, high risk, right? So you want to be able to kind of reflect whatever your inherent and residual risk is from your AML risk assessment, having a direct reflection when you're setting up rules. right? So you want to focus on the high risk. You're not, you want to be able to have that reflection of those rules based on what you think your company might be exposed to. So the AML risk assessment is absolutely the most critical part because it's the foundation of that. That's where it starts. So, and then also, look, if you're building it from scratch, I mean, it's probably a good opportunity to have an automated system. I've seen a lot of, fintech entrepreneurs kind of doing things manually at the offset, which I get. It makes sense as they continue to grow and get funding and so forth. But, ideally, if you're able to, I would say off the bat, start with a platform, a vendor that gives you and allows you the opportunity to scale as well. And so, again, you want to tailor your business, your operations based on what you have in your AML risk assessment to reflect those rules based off of that. Don't just create alerts just so you have alerts. I mean, you might have a great 5, effective rules versus having 100 rules. I mean, it's really not going to make a difference. The fact that you have more rules does not necessarily mean that you have a good, effective transaction monitoring system in place. Again, the foundation is the AML risk assessment. Whatever you think your business is exposed to from a illicit activity perspective, you want to be able to target that, and then your transaction monitoring rules should be a reflection of your AML risk assessment, what you've identified in there. So I would say that's the start of setting up your transaction monitoring rules.
All right, thanks. I really love that you mentioned the risk assessment a couple of times. I've seen quite a lot of companies or had discussions with fellow colleagues from our companies, and I still think that many institutions treat the risk assessment as, just the tick of the box for the regulator, something you have to do every year just for the sake of doing it, and do not really see the connection between the transaction monitoring rules and the risk assessment. So not so many companies actually treat it as an exercise which can help you actually define what you are targeting with your transaction monitoring framework. So yeah, it's a very important note to be considered here, I believe. Madhu, anything from your side to add?
Yeah, definitely. I think it's second what Vic said about number of rules, not meaning you have a better, system, right? From our experience, we've seen ideal compliance programs having 12 to 20 rules. There are some which are run really well with just 8 rules. I think second Vic's point, it's also about just how much you tailor it to your business, right? To your demographics, to the expected user behavior. And it makes a lot of sense to think in terms of typologies, right? And this is something we do, we are very mindful at Flagright. And I can quickly share my screen and just share how we think about it essentially. But we are, we always think about typology, we're typology backward, but we have designed the system in a way that makes it easy for our customers to essentially have very standard set of rules that work really well for them, right? That includes things like the system does recommendations based on rule performance across our other customers, based on what other companies in similar vertical, right? If it's a fintech, maybe another fintech in the same market or similar demographics, what other people are using and how efficient that is. So this kind of recommendations and just ability to search by any typology, if you're thinking in terms of typology backwards, you might want to service something like money mules or something like that. And the system automatically kind of understands what typologies you might be looking for. It makes recommendations based on that as well. So, this is how we think about it. And we've seen this to be very effective, when our customers use it as well. So yeah, absolutely. Just there's no one size fits all, right? It's really dependent on the kind of business, the kind of risk profile you have, and also the kind of risk profile your customers have as well.
That makes total sense for me, and it's good to see that in practice. Thanks for sharing that. All right, so moving on to a bit more practical steps, maybe. Once again, a question directed to Vic. What would you consider some of the best practices for having actually efficient rules, and how could you define the ideal thresholds for having efficient rules?
Yeah. So efficiency, again, in rules is about maximizing your signal to noise ratio, right? Like you want to be able to, get actual suspicious or unusual activity alerts without drowning in, false positives. So that's the whole idea of this. And this is why, I would suggest kind of going back to what I was saying is, your AML risk assessment is segmenting your customer base. If it's a higher risk customer, kind of segmenting that and like focusing on that segmentation, whether it's your high risk products, your high risk customers, your high risk jurisdictions. So you want to be able to segment to those categories versus kind of focusing on, thresholds, for example, or low risk transactions. It's really not about having the right threshold. We talk about thresholds. Yeah, that's good. But because you're kind of setting up a number, but you're really trying to focus on like your high risk. Because if you really think about it from, again, the foundation, right, to be able to kind of prevent illicit activity, you want to be, and then the foundation of the AML risk assessment, what you're essentially doing here is, as an entrepreneur, as a fintech entrepreneur or your compliance team, like you're trying to find ways to see what are some of the gaps. Like, how can someone come into my business, ask for my products and services, and what are some gaps they're able to kind of figure out to be able to use my company for money laundering purposes. So that's why you want to be able to customer segment your products and customers and then the jurisdictions in which they're going to be doing business in, and focus on that high risk clients rather than the low risk. So that's basically the way, essentially how you want to set up your rules is to focus on your high risk customers. One thing I would add is, again, compliance professionals, and then also, need to understand the business. I would highly suggest that, they understand the business model of the business, the specifics of the products and services that they're offering, because there needs to be some exercise, right? Like with the CEO, for example, or with other leaderships within the company, is let's pretend we are criminals. Let's think that way. How can we find ways to exploit our business? So if you're able to kind of understand that and kind of identify that, again, that should be a reflection, and that you should focus on that when you're setting up your transaction monitoring rules.
Okay, got it. Thanks. Very, very valuable insights. Madhu, maybe you want to add anything in here?
Yeah, definitely. I think, to add to what Vic said, one of the things that we've seen being extremely helpful is for compliance team to kind of be able to just act on the data, right? So a lot of the times when you're setting up these thresholds or setting up, which typology you want, you don't really know how it impacts like, your transactions essentially, right? What's going to be your hit percentage? How many users will be impacted? And if it's like a rule that suspends users or suspend transactions, what's like the end result of that? And to Wick's point of understanding the business a bit more, every time you stop a user or every time like terminate a transaction because of your system or freeze someone's funds, there's definitely like consequences of that, right, for the business as well. So before setting these up, like it would be very helpful to kind of know at least the impact, right? Like what is it going to do to my system if I turn this rule on or with this threshold on? With that, one of the ways we allow our customers to do that is what we call simulations, right? I can quickly show that as well on like, how these things, work. But essentially, we allow our customers to simulate the rule before turning it on live. So, to Wick's point, they kind of go with their eyes open, right? On this is the kind of users I want to target, right? I want to target only high risk users. I don't want to, cast a wide net and just freeze accounts of the users who actually aren't doing anything suspicious. So, for you to be absolutely sure of that, what Flagright allows you to do is just simulate the same rule, right? So for example, I can just create a new rule here. And let's say, I want to just have different sets of thresholds, right, than what I currently have. So I can just set that up and I can just run this rule from my historic data set, right? So once I run that, the system automatically crunches the data and I get like a nice analytics report. But with that report, the goal here is to identify, is this rule hitting the right transactions? Are the right kind of users impacted by this rule? And does this rule do what I intend for it to do, right? So in this case, you can see, you get an analytical report like this, and you could see what's like the overall impact. How many more cases do my analysts need to take a look at now? how many more users will be impacted by this? Maybe you're freezing accounts, maybe you're asking for, you're doing EDD on them, or you're asking for more documentation, re-verify KYC perhaps, how many transactions you're going after. And you could also see the specific transactions and, users hit, right? And, as Vic mentioned here, you really want to focus on ensuring that only the high-risk users are hit here, and there are not too many people that you wouldn't want to investigate as a case from alert, right? Yeah.
Yeah, and if I can just add quickly there, Madhu, it's yeah, you make a really good point as well, right? So, I mean, think about it this way, like, your rule for a high net worth individual is going to be different than just a student, right? Again, segmenting customers and the products that they're using. So understanding their data is very important here, because again, you want to avoid and not waste time on your low transaction flows, but focus on like the high net worth individual, like, based on your data, like, what do you know about the data? Is it normal for a high net worth individual to behave this way? So that's really important. I just wanted to kind of chime in on that as well.
Yeah, no, it makes a lot of sense. I mean, I think once you come here, you look at the data here, you could actually create the rule, or, to Wick's point, let's say you want to do more sub-segmentation, right? You could always go back and let me just go here. So yeah, you would want to do some segmentation as well. For example, then you could just say, okay, run this only for, let's say you're onboarding merchants, only run this rule for, let's say, new merchant risk, right? Merchants who are less than 1 year old, or, new user risk, only run it for users who signed up in the last 90 days, for example. So this kind of segmentations helps quite a lot. And we've seen this allow customers to target the rules far better, because when you're creating a rule, the idea is to not spread too wide a net, right? If you're really concerned about new merchants, right, or new merchants who sign up, and are new users of your platform, you should have rules targeting specifically that. Because if you have the same rule running for somebody who's been on your platform for 5 years, let's say, and they haven't exhibited any risky behavior, you're just going to have a lot of false positives, and in the other, and maybe like because of enhanced due diligence, or maybe like temporary suspensions, that user might actually be impacted negatively, leading to like a bad customer experience too, right, for the business. So having these abilities to kind of segment your rules based on virtually any field and run simulations, right, kind of like back tests, we've seen a lot of improvements in the kind of efficiency that our customers are able to have in their transaction monitoring system.
Yeah, and then really, like, you're not going to get it right on the first try, right? Like it's going to be an iterative process. Definitely not going to get it the first time, but at least, like, you could, you have a feedback loop, and like kind of be able to kind of go through an exercise and a process to be able to keep, maybe tuning and segmenting it correctly and things like that.
Yeah, makes total sense to me as well. Yeah, so having the ability to run simulations, kind of giving the safe way to experiment without creating a real-time impact on business. Yeah, and you don't have to be guessing and picking a magic number from the top of your head just to add it as a threshold. So yeah, thanks for showing that, Madhu. So yeah, speaking about the continuity, since Vic mentioned it, let's imagine a situation that we have launched our MVP, like the first set of rules, things are going well. But yeah, everyone gathered here probably knows that things move fast in the fintech business, and really fast. So the question would be, how often should the financial institutions review and adjust thresholds after the deployment, and what would typically trigger those reviews? Vic, I'll probably direct it to you first of all.
Yeah. Again, so how often to typically review? So again, this isn't going to be sort of a one-time set it, forget it, and then you're done. It's an ever-changing process. You want to be able to get, not just your compliance team, but like everybody within the organization. Like it's a collaborative approach, right? Like you're always, whether it's with sales, whether it's with business development, engineering, product, data scientists, whoever it is, you're looking at data integrity, data mapping, so it's an iterative process. It's an ongoing process. I would say, on a high level, kind of schedule your reviews, perhaps on a quarterly or semi-annually. Some institutions do it on an annual basis, depending on where you are within your scope of business and growth. But absolutely, like, if you're starting off, in 3 months, in a quarter, just to kind of go back and see, what's look like. Have you been getting a lot of false positives? If so, then you want to be able to, kind of adjust your rules and, do some fine tuning there. And then also, that would be a triggering effect, right? So not only you have a scheduled review, for example, on a quarterly, semi or annual basis, you also want to have a triggering review period. So what I mean by that is, again, if you're seeing a lot of, false positive, that should be a triggering event for you to go in and just kind of like look at and see why we're seeing a lot of false positives. Also, potentially low SAR filings or UAR filings, right? That should be another, triggering event. So these are like ongoing. It's not periodic, it's more trigger based. And then also the alert to case and case SAR ratios. All in all, these are metrics that you should kind of follow closely to be able to, tune and adjust as need be. So it would be very good to, have a system in place where it's like automatically doing that for you, so you don't actually have to, extract data in Excel spreadsheets and having to run data and asking for your data team or engineering team send me raw data and all that stuff. So if there was a good system in place to be able to kind of extract that and like on the background kind of having that dynamic flow simulation going, I mean, that's a plus. So yeah, it's my suggestion there.
Yeah, I totally agree with you. And yeah, I really like that you mentioned, the compliance team having the keys in their hands to do all this stuff, not having to collaborate with multiple teams just to identify some issues. And yeah, before I give the mic to Madhu, I think we have quite an applicable question from the audience actually, which is how can I decide if a rule is outdated and that it should be retired rather than retuned? So Madhu, maybe you can elaborate on that one and maybe show something as well.
Oh, yeah, definitely. So I think, exactly what Vic mentioned before, like, we saw it with our customers as well, where you'd have these rule tuning exercises that, would go on for a while. You get some Excel, you do some analysis. And of course, tools like, simulation that I showed, which does A/B testing, right? You can have up to 3 experiments, which is completely safe to do because it doesn't create any alerts. It's purely like analytical exercise. They were very helpful, but then, end of the day, you're still kind of guessing the thresholds, right? You don't really know what the exact thresholds are. It would be quite an onerous exercise. And, on top of that, you also need to constantly have these metrics out like, oh, what's the hit rate? What's the false positive rate and things like that. So what we ended up doing was, based on this consistent customer feedback, we built in analytical capabilities right into Flagright. For example, we show you the hit rate out of the gate. Some of the other aspect that, Vic also mentioned as being critical to managing efficiency, which is, what's your timeline of the hit rates, the false positive rate, SAR to alert ratio. So all of these things, we provide these metrics out of the box, right? Along with transaction alerts and users. So one of the things our system does pretty well is we make it very easy for customers to maintain the rule in an ongoing fashion, right? So when thresholds do get outdated, we actually send you a notification, right? So our customers get a notification, hey, the hit rate for this is very high. Maybe it's outdated, right? Or, you're creating a lot of alerts without creating an SAR. Does this rule even need to exist? And beyond that, we also recommend thresholds. So every time we see a drift or we see that our rule isn't performing that well, it could be because of the rule is now outdated, or maybe the initial thresholds were a bit too, conservative or a bit too lenient on the other hand. So the system actually, gives recommendations based on the statistical data, right? In this example, it's asking to reduce the increased transaction count from 50 to 22. And, it's estimating you can save 50% of false positives, right? It'll just go out of the way with just this change. Now, you can still run a simulation, right? You can still run a back test that just, crunches the data, gives you the analytics on, the impact of this change so that you can be sure that, okay, this change is what I want to do. And then you can directly update it. And the system runs all the time, right? It's not like once per quarter. So many of our customers get multiple recommendations every month. And it really streamlines the ongoing maintenance because you don't really need to have this 2-week block every quarter, going through Excels anymore. The system kind of does that for you. And of course, if you also want to do it yourself, we do have the analytical capabilities built into the platform. So that is something that's super critical once you go live, which is, beyond things like simulation, like you also need, more sophisticated tooling to kind of help choose the right thresholds to kind of, prune your compliance program, so to speak.
Right. Thank you very much. Yeah, I got PTSD once again once you mentioned multiple Excels and the back testing, having been there multiple times already. So yeah, seeing those metrics is really, really, really valuable. All right, let's flip a script a little bit. Still staying on the same topic that things are changing and escalating quickly in the fintech business. So let's say the business goes well and you are starting to get bigger and bigger. Vic, how would you approach adjusting rules when the business model or products change? So for example, you are launching a new feature, or let's say the business is starting to scale rapidly. What sort of recommendations would you give here in this case? How to approach that?
Yeah, I would say, again, compliance being at the table at the offset. So anytime you're running or even thinking about launching a new product or a service, compliance should be engaged, right? They're at the table, they're talking about it. Because again, early, I remember, I think a lot of us can relate that earlier in our careers, we always thought like compliance was just a cost center, right? Now where everybody's talking about that. No, now we get it. It's not a cost center. We don't need to fight with business development or sales, because at the end of the day, our efforts in maintaining a good program to detect and prevent any losses within the company, I mean, that's a strategic sort of partnership, right? Like we're not going to be paying out enforcement actions, consent orders, or having losses on our books. So it's actually more beneficial. So we hold on to the hard-earned revenue, for lack of a better word. But compliance definitely should be participating early on in that engagement for new product launch. And then also, again, this goes back with the risk assessment. I mean, we need to know what these products are, who are serving, what jurisdictions are going to be offered in, and that needs to be embedded in the risk assessment. And again, once it's embedded in that risk assessment, it's the foundation. It just kind of trickles down. Now we need to think about, all right, so how do we set up certain rules to reflect certain typologies with regard to those new services or products or regions? So, again, and then adjusting the rules again with this type of stuff, past behavior, right, might not necessarily be fruitful at this point because you just don't know. So again, running simulations, mock analysis, mock simulations, and things like that is probably going to be your best bet. But then again, kind of going back, all of this is not a one-time set it and forget it exercise. It's iterative, it's ongoing, and everybody's kind of involved. So those are some of the, best practices, I would say.
Okay. Madhu, anything to add from your side on this one?
Oh yeah, definitely. So, cannot stress the same point enough, which is like, it's an ongoing exercise, right, all the time. And especially when it comes to like newer products or newer demographics, maybe you're expanding to a new region, you're expanding to a new customer segment. You just don't have enough like, data in the back end to kind of like, validate some of the typologies or some of the configurations you want to have up. In that case, the better to do is, of course, start with like a simulation, as Vic mentioned, right? Have some dummy data on what the data looks like. One of the things that we've seen our customers do more consistently recently is just do what we call the shadow mode, right? In which case, what they do is when they're expanding to a new market or something, they actually set up some thresholds based on, whatever simulation, they do before. But instead of making it a live rule, they make it what we call shadow mode, where the rule still runs. So they usually run a limited pilot with some customers in the new segment, but the rule still runs, but it doesn't create alerts, right? So it just collects metrics on like the performance of the rule. So that way, you make up for like just the absence of historic data, right? Because this is completely new. So you're just testing these things out. So, simulations are more backward looking, and, shadow rules that we just saw are more forward looking. So this is like, going to give you analytics like this one that we see here, right? Same hit rate, It'll still tell you which transactions would be hit and how many alerts would be created. It just won't create these for you, right? So you get the full analytics. And if you're happy, you can, turn it live, you can simulate on top of this, and you can just, go from here. So yeah, so having like systems like this in place is going to be it's going to be enormously helpful because just allows you to just go into these things with your eyes open. And once you do have it, you start off at a good foundation for you to kind of evolve your transaction monitoring setup from that point forward.
All right. Thank you very much. Yeah, I believe once again, we're getting back to that space to learn without putting your control at risk. And once again, a feature which seemed to be very, very valuable for, experimenting with rule setups, especially if you launch some sort of MVP and you have some transactions flowing in. All right. So since we were kind of on this fintech journey from the start, of choosing the right vendor, then approaching the initial rule setup, weakening threshold, et cetera, et cetera. I believe all MLROs and compliance officers know that at some point, I think it's usually on a quarterly basis, but it differs. You have to present whatever changes you have done and how it impacted the business to the board. So how would you approach the board reporting, Vic, and what would you say needs to be communicated during those board reports?
Yeah. So yeah, ultimately that's important, right? Because, if again, kind of mentioning your risk assessment, right? Like it's that foundation. Your board has signed off reviewed and signed off on that risk assessment. Because ultimately, as we know, board has the ultimate responsibility, for the oversight of the program. So now you want to be able to report back to them, right? Of how the program is going, how effective it is. So I would say a couple of things here. All those statistics are very important to report during board meetings. I would just say, kind of from experience, is don't just focus. I mean, statistics are good, but don't just focus on the statistics when reporting to your board. Provide some meaningful metrics, right? Like not just numbers. Like what does this mean? Like were we able to mitigate the risks that we all sat down and we talked about it, right? When we were setting up the risk assessment, or when we are identifying certain typologies and things like that for our products and customer segmentation. Provide some qualitative insights as well, right? So I think it's important to say to the board where hey, you know what, for our high risk P2P clients, we reduce false positive X percentage by changing Y to XYZ, for example. So you're providing some information as to how you're mitigating this, this whole AML, money laundering typologies and things like that. And ideally, it would be very, very nice to provide some graphs, obviously some numbers and statistics with, which customer segment resulted in high alerts and how many of those alerts actually converted into a case for investigation. And then, how many of that really converted into an actual SAR filing or a UAR reporting to our banking partners. So you want to be able to provide all of that. And then also, hey, we have all these alerts. We're going through it. It's taking us an hour to investigate or review an alert. We might need certain additional resources, additional tech, et cetera, et cetera. So, those are important. And I know it's also a burden oftentimes to be able to, during board reporting timeline, having to extract, again, getting to our data team or product team or whoever is in charge of data to, extract certain data to be able to pivot table, create pivot tables and graphs and charts and things like that, so that you could have a nice illustrative picture in your meeting presentation to the board. That takes time, but ideally, it's really important to have some sort of graphs and meaningful risk mitigation parameters in place to show how effective your transaction monitoring program is running.
All right, thanks. Yeah, from what I understood, it's quite a tricky balance. Yeah, so boards do not really want the full alert breakdown. They want outcomes and clarity, basically, and you have to translate that compliance language to a business language, essentially. Yeah, Madhu, anything you would like to add here?
Yeah, sure. I think that's one of the things that many of our customers did mention to us, which is the amount of time it takes to just get this data together, right? And it's just so time consuming that you may not have time to actually have like, a narrative, right, for the board, actually telling them what actually is going on. But, it just takes so much time to actually get the raw data out, which is why, we focus a lot on analytical capabilities, like things like, overall efficiency and things like that. Of course, the platform like Flagright itself cannot have the narrative, right? It's going to give you the raw data. But we've seen that just exposing this raw data to be easily accessible by customers makes it very easy for them to just put in some graphs on the board and just focus more on, what the narrative is with the current state of the compliance program, as opposed to, hey, we had 1,500 alerts this month, right? Which really isn't that useful for a board, right? What would be useful for a board is like, oh, of new customers we're onboarding, maybe, this is the segmentation. We have, a clearance rate of X, right? We have 1,500 alerts, which means we need to increase headcount by X or Y. So I think the narrative should definitely take precedence there. And just having the data readily available just, allows you to kind of focus more on that front, as opposed to just, here's the exact statistics from our system.
Yeah, and I see it time and time again, right? It's like you're going through a board reporting, and then all of a sudden you see like certain tables where for this month we had 100 alerts. For this month we had 500 alerts, and so on and so forth. And it took us this much time, or this much days to resolve these alerts. Well, look, what does that tell me? From a board perspective, if I was, a board member and understood compliance, having that compliance mindset, right, is all right. So like, great, but are you here just reviewing numbers and reviewing alerts? Are we seeing anything come out of those alerts? Because again, the idea is to set the rules to be able to identify or trigger actual potential unusual or suspicious activity. But if you're just reviewing alerts and you're telling me that you just reviewed 1,000 alerts this quarter and you cleared it, what does that tell me? Like, it doesn't tell me our program is effective. Like, it really doesn't. So that's why I think it's important that board understand, what we're doing here and how are we mitigating the inherent risks that we all set down initially to talk about. How are we doing all that? How are we, foreseeing the biggest challenges in these financial crime typologies and things like that? So again, it's really important to provide some meaningful information when you're reporting to the board when it comes to this.
Yeah, totally agree on that one. Okay, I think I ran out of my questions and I'm wary of the time, but we have one question which I believe could wrap things up a little bit. So very quickly, looking across this rule tuning lifecycle, so from the setup to ongoing adjustments, reporting to the board, from both of your own perspectives, where do you see teams maybe facing the biggest challenges in practice, actually? I believe it kind of goes back to what you mentioned, Vic, with the immutable risk assessment, as this is a foundational part, but maybe you can elaborate a little bit more for wrapping up.
Yeah, so I think just to kind of add on to that, like a lot of the challenge that I'm seeing right now in the fintech space, again, especially the startup, emerging fintech companies, is a couple of things here. I'm seeing a lot of, resource constraints. You have, let's say, one compliance analyst or two compliance analysts doing everything from operations, KYC, clearing sanctions, and then transaction monitoring. Like it's really not efficient and effective, and ideally recommended to do. So there's a lot of resource constraints. I'm also seeing that a lot of fintechs are actually trying to kind of build their own sort of manual in-house transaction monitoring systems where 3 months, 4 months down the line, they're like, you know what, we just wasted a lot of time and energy and resources to building that. We should have just kind of go out, get a vendor, and just kind of scale from there. That's the second thing. And then the other thing is, the constant evolving trends in this regulatory environment and the financial crime environments. Like, as technology enhances, so do the different ways these bad actors can sort of exploit, find different ways to launder money. So these are biggest challenges. So, I would say if you're starting from scratch, just do it the right way. Definitely partner with a reputable, scalable, flexible vendor to be able to kind of help you kind of grow as your business operations grows, but also at the same time, having dedicated skilled resources specifically for transaction monitoring. And don't hire individuals just to review and clear alerts. Hire individuals that have sort of a investigative mindset to be able to find patterns that are literally suspicious behavior. So I would say those are some of the challenges that I'm seeing fintechs facing right now.
Thanks, Madhu. Anything to add here?
Yeah, definitely. I think, one of the challenges we see consistently is just when it comes to the compliance mindset, I think people tend to over-index a bit on just, what we call the infrastructure capability, like how does the transaction monitoring work? How does XYZ work? And they under-index, like they care less than they should about like the operational aspect, right? Especially fintechs do this a lot where they're like, oh, maybe we'll just get a solution that's the cheapest on the market, or maybe we'll just do the bare minimum and things like that. And, they do go with decisions like that. And then turns out they now have, 300,000 alerts. And now they have to hire a whole team to kind of just do alert clearing, right? Or they need to get a consultant in just to do that, or like they need to outsource it. It just makes the problem bigger than it should be. I think in terms of like, doing away with the struggle is just thinking about this very clearly from the get-go, right? I think the risk assessment is like super critical here, but just have a more holistic view before you choose a vendor, or even before you start your compliance program, and on all the aspects of the compliance program. It's not just, oh, I want screening today, I want transaction monitoring today. It's like what entails the full program, and what could be the costs associated with it, right? Because you could get, you could do everything in Excel, but maybe you're going to need like a team of 10 people, which could be, exponentially more expensive than getting a vendor who can actually do that. And now you just need a team of like 2 people, but those 2 people are actually doing compliance as opposed to just saying yes or no on an alert, right? So I think that's kind of like what we're seeing on our end.
All right, thank you both. Unfortunately, we ran out of time, but this is not the last webinar. So yeah, we'll continue those. So yeah, I want to thank both of the speakers for sharing valuable insights today. Also, a big thank you to everyone in the audience who joined this conversation, was a part of it. I just want to mention that the full recording of the session will be shared shortly, so keep an eye on our LinkedIn page where it will be posted and available for rewatch or to share with your fellow colleagues. And as mentioned, we got more webinars coming up on a range of compliance and risk management topics, so stay connected with us for more updates. Wishing everyone a great day ahead, and goodbye for now then.
Thank you very much.
Thank you very much.